Hello and welcome to G Fun Facts Online. Have you noticed? An eerie silence has fallen over the housing market. Just a couple of years ago, it was a frenzy of bidding wars and lines for open houses. Now, stillness. This isn't the loud, explosive chaos of a market crash. It's something quieter but just as tense. It's the sound of a stalemate. We are living in a stuck housing market, a place where sellers are locked in and can't sell, and buyers are priced out and can't buy. Today we're going to dissect this strange economic paralysis. We'll explore why your neighbor with the perfect house isn't selling, why homes are more unaffordable than ever, and how this gridlock is sending ripples through our entire economy and even our personal lives. So, what does a stuck housing market really mean, and how did we get here? Let's break it down. A stuck or frozen market is defined by one key thing: a dramatic slowdown in the number of homes being sold. The volume of transactions seizes up. Prices aren't necessarily plummeting like they would in a crash, but they aren't really growing either. They've hit a plateau. The defining feature is inactivity. This gridlock is created by a perfect storm of factors that are squeezing both the supply of homes for sale and the demand from potential buyers. On the supply side, the biggest reason the market is frozen is something economists call the lock-in effect. Millions of homeowners, especially in the United States, bought or refinanced their homes between 2020 and 2022, when interest rates were at historic lows. They secured mortgage rates between 2.5% and 4%. Now, with current rates hovering between 6% and 7%, the idea of selling and buying a new home is financially terrifying. Let's put some numbers on that. Imagine a homeowner has a $400,000 mortgage at a 3% interest rate. Their monthly payment for principal and interest is about $1,686. If they were to sell their house and take out a new $400,000 mortgage today at a 7% rate, their payment would skyrocket to around $2,661. That's nearly $1,000 more every single month. Faced with that math, would you move? Most people are saying no, even if they need more space for a growing family, want to move for a better job, or wish to downsize for retirement. They are choosing to stay put. They are, quite literally, locked in by their low mortgage rate. This has trapped a huge amount of potential housing supply off the market, with over 80% of borrowers having a rate significantly lower than what they could get today. So that's the supply side. But what about demand? While supply is trapped, demand is being crushed by a severe affordability crisis. The very same high interest rates that are trapping sellers are also sidelining potential buyers. The combination of home prices that surged during the pandemic and today's higher borrowing costs has pushed homeownership out of reach for a huge portion of the population. A household earning $100,000 a year can now afford only a tiny fraction of the homes for sale, compared to a majority of them just a few years ago. This creates a strange paradox. Sales are plummeting, yet prices remain stubbornly high. Why? Because the inventory of homes for sale is so incredibly low that the few buyers who can afford to be in the market are still competing for a very limited number of properties. It's a standoff. Sellers won't lower their prices because they don't have to, and most buyers simply can't meet those prices. Interestingly, there's a split between the market for existing homes and new construction. While the resale market is frozen solid, homebuilders have a few tricks up their sleeve. They can offer incentives like mortgage rate buydowns, where they subsidize the buyer's interest rate for the first few years, making a new home more affordable. This has made new construction a relative bright spot, but builders can't solve the entire inventory crisis on their own. And this isn't just an American problem. This gridlock is a global phenomenon. In the United Kingdom, the market is described as being in a state of stagnation. Sky-high interest rates from the Bank of England have squeezed out first-time buyers, and recent tax changes have caused many landlords to sell their properties, adding some supply but also putting immense pressure on the rental market. Canada is facing one of the most severe housing affordability crises in the developed world. A unique factor there is the boomer bottleneck. A huge portion of the country's detached homes are owned, mortgage-free, by baby boomers who have been slow to downsize. This, combined with a massive surge in immigration creating a historic demand shock, has led to intense gridlock and a society of housing haves and have-nots. In Australia, it's a crisis of a massive imbalance between supply and demand. Record immigration has created a desperate need for housing, but the construction industry is hamstrung by labor shortages and high costs, making it impossible to keep up. While the local reasons vary, the result is the same around the world: low transaction volumes and a market that feels stuck in mud. Now, a crucial question is, have we seen this before? Is this just a temporary freeze or the start of something worse? To answer that, we need to look at history. Many economists point to the U.S. housing market of the early 1980s as the closest historical parallel. The situation was strikingly similar. The 1970s saw massive inflation, which prompted the Federal Reserve to raise interest rates to unprecedented levels. The 30-year mortgage rate peaked at a staggering 18.4% in 1981. The effect was chilling. Home sales plunged by nearly 50%. Yet home prices did not crash. They flatlined. Why? Demographics. The huge baby boomer generation was just entering its prime home buying years, creating a powerful wave of underlying demand that put a floor under prices. This shows that when strong demand meets high interest rates, you often get a transaction crash, not a price crash, a stuck market. It's also vital to distinguish today's market from the 2008 global financial crisis. The 2008 crisis was caused by the housing market itself. It was fueled by lax lending standards where almost anyone could get a subprime mortgage and a massive oversupply of new homes. Today's market is the polar opposite. Lending standards are tight, and today's homeowners are generally well qualified with significant equity in their homes. And our core problem isn't oversupply, but a chronic undersupply of homes for sale. This is the key reason why most economists predict continued stagnation, not a 2008-style crash. So why should you care if you're not looking to buy or sell a house? Because a frozen housing market sends ripples everywhere, affecting the entire economy and our social fabric. When homes stop selling, the economic activity tied to them grinds to a halt. People feel less wealthy and pull back on spending on things like furniture, cars, and vacations. Industries like real estate, moving companies, and home improvement stores all suffer, which can lead to job losses. But perhaps the most damaging consequences are social. A stuck market paralyzes labor mobility. A dynamic economy relies on people being able to move to where the jobs are. But that lock-in effect we talked about throws a wrench in the works. A worker might be offered a fantastic, better-paying job in another state, but turning it down becomes the only logical choice if it means trading their 3% mortgage for a 7% one. This traps people in regions with weaker job markets. It also has a profound impact on family life. Young couples in a starter home can't upsize to make room for children. Older retirees can't downsize into a more manageable home, which also keeps that family-sized housing stock off the market. Life gets put on hold. So what's the path forward? The consensus among economists is that this gridlock won't disappear overnight. The thaw will be a slow, gradual process. Most forecasts suggest mortgage rates will only ease modestly through 2025, likely staying in the 6% range. A return to the super low rates of the pandemic era is not on the horizon. Because of this and the persistent shortage of inventory, a major price crash is considered unlikely. Instead, we can expect modest, single-digit price increases for the next couple of years. For buyers, the outlook is one of slow, incremental improvement. For the first time in over a decade, wage growth is expected to outpace home price growth, which will gradually help restore some buying power. But a true buyer's market is likely still years away. The Great Housing Market Freeze is a complex story of economic forces and human psychology creating a market in suspended animation. History shows us these periods can resolve without a catastrophe. The ultimate long-term solution, echoed by nearly every expert, is simple to say but hard to do: build more homes. By addressing the chronic housing shortages that got us here, we can work toward a more fluid, accessible, and dynamic housing market for the future. Thanks for tuning in to G Fun Facts Online. We'll see you next time.